The following script was written, verified, and approved by compliance professionals at financial regulation courses. An initial public offering is the process by which a privately held company first sells shares of its stock to the general public. This transitions the company from private ownership with a limited group of shareholders to public ownership on a national securities exchange. The IPO is a fundamental change in governance, disclosure requirements, and access to the world's deepest pool of capital. While it funds growth and provides liquidity for founders, it also subjects the company to ongoing SEC reporting and quarterly earnings scrutiny. Statutorily, the IPO process is governed by the Securities Act of 1933, which mandates full and fair disclosure for new issues. The process begins with selecting underwriters. A lead bookrunner manages the syndicate, assuming primary responsibility for distribution. The due diligence phase involves preparing Form S-1, the primary disclosure document describing the business, management, and material risks. This registration must include audited financial statements for typically 3 fiscal years, prepared in accordance with US GAAP. During the cooling-off period, the preliminary prospectus, or red herring, is distributed. It lacks the final price and effective date. Under the Jobs Act of 2012, emerging growth companies with under $1 billion in revenue may file a confidential draft registration. The Roadshow is an intensive marketing campaign where senior management presents the investment thesis directly to institutional investors. Concurrently, underwriters perform book building, collecting indications of interest to assess demand and determine the appropriate offering price. Pricing occurs the evening before trading. The company and underwriters execute the agreement, setting the final price based on demand. A critical feature is the Greenshoe, or over-allotment option, giving underwriters the right to purchase 15% more shares. This allows underwriters to stabilize the stock in the secondary market by purchasing shares if the price falls within 30 days. Historically, US IPOs experience underpricing, with average first-day returns of 15 to 20%, leaving money on the table. Theories for this include the winner's curse, compensating investors for risk, and signaling high quality to the market for future offerings. However, academic research shows long-run IPO performance over 3 to 5 years is often inferior to comparable non-IPO stocks. One of the most important structural features is the lockup period, contractually restricting insider selling for typically 180 days. This prevents insiders from immediately flipping shares, which could signal negative information and suppress the stock price early on. The expiration is closely watched, as it represents the first opportunity for massive insider selling, often causing localized stock price weakness. Secondary offerings later allow the company to raise more capital or let existing shareholders achieve liquidity through registered sales. Alternative structures like direct listings allow existing shareholders to sell directly to the public without new capital raising or underpricing. Special Purpose Acquisition Companies, or SPACs, raise IPO capital specifically to acquire a private target, bypassing traditional underwritten paths. FINRA regulates broker-dealer conduct, strictly prohibiting practices like spinning, the allocation of hot IPO shares in exchange for banking business. For examination preparation, candidates must understand the registration process, the role of underwriters, and price stabilization mechanics. Remember, the red herring lacks final pricing. The Greenshoe is for stabilization, and lockups typically last 6 months to protect investors. At its core, an IPO is the first sale of shares to the general public, strictly governed by the Securities Act of 1933. Visit financialregulationcourses.com for finance resources, professional development, and SIE and Series 7 preparation to advance your career.